Good morning. It's Gregory Prato from Prato Capital. We've all know each other long enough to know that one of these exceptional times demand exceptional discussions. And today, many of you have already met a good friend, but more importantly, an amazing professional at Dimensional Fund Advisor is Apollo Lepescu. And I am thrilled to be able to have Apollo again talk about the broader markets. The title we really have given Apollo globally is the Director or Secretary of Explaining Things. So with that, I'd like to just say hi to Apollo. Good morning out there, Apollo, or good afternoon.
Hi, Greg. How are you? Good to see you.
Yeah, you as well, Apollo. And again, I know a lot of the folks have already had an introduction to you in the past. You've been here at Prato Capital. You've done webinars with us, which have just really been well received. So I guess the question that gets often asked is this the right time? So with that knowledge, is it that important to worry about, are we getting in at an all-time high, or conversely, is this the low we should be getting in? The proverbial timing of the market discussion. So yeah. The question there remains, does it matter that much, historically speaking, to be picking the right time to enter the market?
Yeah, and it's so interesting. It's so interesting because I think, if I remember correctly, it was in October. One of the questions that I got at the seminar that he had was exactly that. Is it wise to invest at market all-time highs? And then people were all nervous about that. When the market dropped, people are also worried, is it time to invest too low? So there's always something that's not quite right. But what's interesting is that being at an all-time high is not terribly unusual for the market, because about one in 3 months historically in the U.S. market, in the S&P 500, it's been an all-time high. So all-time highs, it's nothing really unusual. But is this a good time to be investing? That's a really good question. And what investors need to know is that you have to start by not necessarily thinking, is this a good time to be invested in the market? I don't think that's the first question that investors should ask. I think a much more important question is, what am I trying to accomplish in my money? Why am I investing to begin with? Because there are situations where people might not be as heavily invested in the market. For real, they should not. I mean, if you need the money over the next 6 months or 12 months, I'm not sure that it's really, you should pile all the money in the stock market. I don't know that. It's just, you need to start with understanding, why are you investing in the first place? And that's a huge role that you play, and you and the team there at Prato, because the job of an advisor is to put together a lot of these pieces of the financial puzzle that an individual and a family has, and ultimately create a financial plan that would inform whether or not you should be invested in the market. And I'm going to share something with you that I always found it really fascinating, is that when you look at the stock market, and a lot of people know, should I be invested? Well, what we know is that over the long run, the U.S. stock market has grown on average of about 9 to 10% per year. And that's the long-term average of the U.S. stock market. And I'll consider the S&P 500 to be that measure of the U.S. market performance. Now, what's so fascinating is that in the history of the market has been a history of ups and downs, lows and highs. The nature of the market is to fluctuate, because you're buying fluctuating profits, so does the market. It fluctuates. So there's nothing unusual about fluctuating market and having highs and having lows. It has been a very rewarding ride. And if you look at, we have a book called The Matrix book that is actually with me everywhere. I love this book, The Matrix book. And it looks at what would be the reward of investing in the stock market. $1 invested back in 1926, that's when my dad is born, would have grown significantly. In fact, by the time he turned 92, he's 93 today, that dollar would have grown to roughly about $7,000 as it is in this 2019 version of the book. So it's a very, very rewarding ride in the stock market. The question is there a trigger to say, when the market hits a high or a low, should I be doing one thing or another? And there are two very clear strategies. One is that you stay disciplined, and the other one, and you ride this roller coaster through the ups and downs. Or the second is that you decide that at times you should get out of the market and at times you should come back in. And that is typically called market timing. What I can tell you is that I have tried this, either looking at market being too high or too low. I have talked to countless investors. I've researched and talked to managers. Here's what I found is that if you think the market's too high or too low and you decide to get out of the market and stay on the sidelines, there's an equally important decision that investors have to make at exactly the same time, which is, when do you get back in the market? And I'm not aware of anybody who can consistently make that decision, two decisions correctly at the same time. So it's not just we need to get out because the market's too high or too low. When do you get back in? That's the big question. And to me, I think it's not something that investors can control. I don't think that you can go and control and say, well, I know when to get back in the market, because, you know, things happen. Nobody knew that this pandemic would happen. So things happen, good or bad, and that will drive the market. So not knowing when to get back in is one of the most dangerous things, because what often happens is that by the time things look good again, the market would have recovered. If you're waiting for the economy to fly high again and the smoke to clear and everything to look good, it's likely that by then the market might have recovered. And if you miss that, then you basically have taken something that could have been a temporary paper loss and turn it into a permanent loss.